What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some in-depth stock analysis on Domino's stock. Now, this is a stock that I've never owned before, but I've had their pizza, and their pizza is pretty good. But today, we're going to take a look if the stock is a good investment. So there's definitely some surprising things here that caught me off guard. So let's get started with this. Right off the bat, let's take a look at the share price. It is $359, and this market cap is $12.7 billion. Now, in the last 5 years, it's up over 70%. It reached an all-time high of $564 in the very last day of 2021. Today, we're sitting at $359, and on the year, it's down 19%. So it definitely is sitting in a little bit of a dip right now. Now, before we get started with my checklist, okay, we're going to take a look at something here. We're going to go to Google Trends, and we're going to see what are people searching for the most, Domino's, Papa John's, or Little Caesars. And the good thing about this chart is that Domino's has more than twice the number of searches than both of its competitors. The bad part is that it's really flatlining at best, and really it looks like it's decreasing over the last 3 years, let's say. So that's the bad part, is why are the searches down to 48 right now when they were sitting at 65 to 70 for years on end. So that's something that was kind of interesting to me. It's good that they're ahead of their competition, but kind of suspicious why it's downtrending like that. Not a make it or break it type of thing, but still something to just think about. So number one on our checklist is going to be, if you haven't noticed, I condensed my checklist now down to 16 criteria. So as long as it hits 12 of these, it's going to be considered a buy. So the first thing on my list is going to be, is the revenue and the net income, are they increasing? So we're going to go over here to one of my favorite websites, Qualtrim, and we're going to look at revenue. What we can see here is they've done a great job growing revenue, right? The most recent quarter, they did $1 billion of revenue. So that's pretty good. Then we're going to look at net income. The net income chart looks pretty good too. Yes, it came down a little bit from early 2022, the last couple of quarters. The rest of the year were not as strong. They did $100 million a quarter in net income, it looks like. So not horrible. There still is upward growth that you can see, as the years go on. So that'll get a check. Then we get to, is the PE ratio healthy for its 2023 expected earnings? I put yes, because it's sitting at a 28 right now. It's actually a trailing PE of 29, forward PE of 28. But the important thing is to go look at, where does it normally trade? So as we can see here, in the past, coming out of the 08-09 recession, it went all the way down to a 5, right? Now that's probably not realistic to where it's going to trade at today. It soon went up to a 16, and then from 2013 to now, so now we're talking 10 years, the stock is traded at a PE ratio around a 27 up to maybe a 27 to a 30. It went all the way up to 49. It's hit 40. It's hit 40 several times. And the lowest we've seen it get is really about 25. This past September, it hit a 25. And it's hit 26, and it's hit 26 again. So 25, 26 is going to be prime territory for where you want to buy this stock, but we're not there right now. We're sitting at a 28, so a little bit above, but not bad, especially compared to all the times it went up to 35 to 40. So right now it's not too bad. So I'm going to give that a check, that it's sitting at a healthy price to earnings ratio, more so on the cheaper side than where it normally trades. Number 4, is it innovative? Do they have a moat? Yes, I would say absolutely. And that is because if we go ahead and type in Domino's robot, what we're going to see here is, yes, they are innovating, which is, a pizza company might be one of the last companies you expect to be innovating. But guess what? Domino's is ahead of the game. They're looking out towards the future. They're saying, okay, how can we increase our margins? How can we beat out the competition? And what are they doing? Well, they're testing a self-driving robot to deliver pizzas in Houston, Texas. And this is what it looks like. So pretty interesting, right? Pretty interesting here. And if you haven't looked at ARK Invest's new PDF they just put out for their big ideas of 2023, this is something they talk about. They talk about how It's going to save money and all this stuff, right? So that's something interesting if you want to look at that. But I would definitely consider that some innovation. So that's going to get a check. Number 5, is the industry growing? Yes. I actually looked up, what is the pizza industry going to grow at? Well, it turns out it's going to grow at 6% a year for the next couple of years. So not only that, but people are going to keep ordering pizza. I think we know that. The robots that are delivering the pizza are probably going to increase even faster than 6% a year. And so I'm going to consider that a check. Number 6, this was one of the things that surprised me. Return on invested capital, I gave it a yes. And if you haven't seen my Microsoft video, I made a Microsoft video a couple hours ago. Go look at that one and go look at what their return on invested capital numbers are. Then come back and look at this one. We're going to go down here and we're going to look at return on capital employed. Now, when you first look at this chart, you think, okay, the numbers in the recent years look kind of low, right? When I first saw that, I said, okay, that's got to be 5 to 10, that's got to be 6 or 7%, right? Well, the thing that throws me off here is if you look at the left-hand side of the graph, the chart does not start at 0%. It starts at 10%. So when we go down here, this is actually 17%. This is on the very low end. Look how low that is compared to what they've done in the past. That means they did 35% in 2012, 36% in 2013. 2016, they did 38%. They did 48%. Then they did 40% again. Then they did 34%. So it's just, they've done fantastic. Now, if you compare that to Microsoft, their numbers were 7% in the last couple of years. 7% return. Domino's is getting 17% as their worst quarter. Worst quarter in the last, or 14%, let's say. 14% in the last 13 years has been their lowest year. So that is phenomenal. I was surprised when I saw that. That's going to get a check, absolutely. Number 7, do they have healthy cash flow? I put yes, a price to free cash flow of 30. Not bad. So if you want to look at the cash flow statement here, you can see it's nothing too low. Free cash flow looks good. They're building up a little bit of cash on their balance sheet. Not enough, I would say, but they're in the right direction. And we see that they're also investing in things like the robots. So that's all good stuff there. Here's their cash flow statement. It's back at where it was 3 years ago. Yeah, 3 years ago it was sitting at $500 million, and that's where they're at today. So we came back down a little bit, but that's okay. They're investing some money. They're investing what? Anywhere from 5 to 10%, right? No, really, no. Yeah, 5 to 20%, let's say, of their operating cash flow is going to be invested. And overall, I would consider that it's not bad. Nothing sticks out like it's that bad. Number 8, diverse revenue streams. This is going to get a no. I try to look at this from different perspectives, but the bottom line is they sell pizza, they sell pizza sauce, and they sell franchises where they collect a fee from other people that are making pizza. So that's the business. They make pizza and pizza products, and that's it. So I can't really count that as diverse streams of revenue. It's all based on pizza. Number 9, is the equity growing? No, it's not, unfortunately. And this is the biggest surprise of this whole video. I was shocked to see this. You don't see this very often. Not for mature companies like this one. Their equity is a negative $4.2 billion. And it's gotten worse. 3 years ago, it was a little bit over negative $3 billion. Now we're sitting at over negative $4 billion. So that's the main problem with this company. Up until that point, I was pretty convinced that I was going to buy some shares, but not anymore. Number 10, is the equity over 15% of the market cap? No, it's less than 0 because they don't have $1 of equity. Number 11, how's their share count looking? Well, if we come back to this and we scroll down, what we will find is that they have no problems with decreasing their share count. Nothing crazy, but at least it's going down. That's all we care about. Number 12, are insiders or big money interested? This one I had to dig through a couple different sources because for some reason, unfortunately, these sources do not line up. This website, dataroma.com, they're showing me that in the last year, 0 purchases were made of the stock, 14 sells were made. The Wall Street Journal is telling me that in the last 12 months, 63 sales were made and 18 purchases were made. Something's not lining up here. Actually, unless they're talking about, I have an idea. No, I don't know what that is because that's only based on insiders. Something doesn't add up here. Then we look at the big, funds like BlackRock and Vanguard. They're adding. If we scroll down here, we will also see that other, you got Vanguard, T Rowe, all these different funds that are I see more green than red. So overall, there's big funds adding shares than more so than selling. So that's going to get a check. Number 13, respectable management. I'm sorry, everybody at Domino's, but this is going to get a no. Why do you have negative $4 billion on your balance sheet? I don't understand that. So otherwise, you get an A+ for getting such high returns on capital employed. I'm very impressed. But sorry, you can't have negative $4 billion. You have a simple business. You just make pizza and you tell other people to make pizza for you. That's it. So you shouldn't have negative $4 billion. Number 14, do they have more cash than average income? No, it's about, I think it's I want to say it's 100 and 500. Let's see here. Net income, there'd have been $100 million a quarter. Let's say that was 150. So let's say it's 400 to 500. I think it's 500 million, $400 to 500 million of net income in a year. And the cash, where's the cash? The cash is only like 100. So a little bit off there, but again, not the biggest problem on their balance sheet. It's the long-term debt. So cash is 114 million. But if we go to long-term liabilities, this is where the issue is. Long-term debt, $5.2 billion. A little bit of an issue there. Number 15, healthy dividend. Yes, I would consider this pretty healthy. 1%, you ain't going to get rich off that, but it still counts as a dividend. And the payout ratio is pretty low. I think it's 30%. Let's see, I'm pretty sure it tells us right here. 34%. Good enough. That's good. And the company is over 20 years old. Yes, they are. They were founded in 1960. So overall, this company will receive 11 out of 16 on my checklist, which is considered not a buy, unfortunately. So sorry, Domino's, you guys got to do a better job with your balance sheet. You should not have negative $4 billion, but you're doing a phenomenal job with the way you're investing your money. And one of those ways is with robots, and that's phenomenal. So hopefully those robots can increase your profit margins, put some more cash on your balance sheet, and hopefully you guys decide to pay off some of your debt. So thank you for watching, and I will see you guys in the next video.